Hey guys, welcome back to the Fourth Point Wealth channel. I'm Chris Janeway, your host for the day, and we're picking up where we left off on Investing and Finance 101. If you're coming to us from our What is a Stock video, awesome. This is kind of step two on the main difference. If not, I'll put a link up here in the box to our What is a Stock video. So step two is going to be what is a bond, right? These are our two most basic forms of investment, and then we'll kind of get into all the funds and things that are out there. But what is a bond? So if you watch the prior video, companies will try to raise money for investment in their future growth by issuing stock, right? So they're selling off ownership in the company, raising all that money. Now they can reinvest and hopefully grow their profits moving forward. Well, what if a company doesn't want to get rid of ownership? What if they want to maintain that control? Because all of that ownership gets a vote. What if I would rather bring in money, whether because I'm really financially strong and I don't have to pay crazy interest rates on a loan, or because maybe I'm just not worth very much and I can't get a whole lot for selling shares? The other option is bonds. And again, going back to the terminology doesn't have to be as complicated as it always is. It's a synonym for something easier. If I'm taking on leverage, if I'm selling bonds, I'm just asking for debt. People are giving me a loan, right? And so when a company or government will issue a bond, what they're doing is they're asking you for a loan as the investor, right? And these can trade both directly because I can buy that from the issuing company or government, or they trade around on the same trading platforms that we talked about last time. So a bond has different risks than a stock. My risk, again, on a stock is that, well, the value goes down and I could lose some of my investment or even all of it, right? The risk on a bond is a little bit different. When I give somebody a loan, right? So let's say I give them $1,000 and they're going to give me 5% interest, right? They're going to give me $50 per year. And let's say that loan was for 5 years. At the end of 5 years, I get my $1,000 back. Right? So what's my risk on a bond, on a loan? It's that they don't pay me back, right? Whether they can't pay me the interest, or the bigger one is that they can't pay me my principal, my actual loan back, right? And depending on how all of the loans are structured, but at the most basic level, a bond, they'll pay you interest, and then at the end I get my principal back. Now, different companies, different governments carry different risks to give money to. No different than if I were to go down the street and somebody that I barely know came up, tapped me on the shoulder and said, hey, I need 20 bucks. Can you lend it to me? I'm less inclined to do that than if somebody I've known for my entire life who's great financially, really responsible, comes over and says, hey, can I borrow 20 bucks and I'll pay you interest by this deadline, right? These are two very different things. Well, it's not unlike our credit score, right? We as individuals have our FICO credit score. There's tons of discussion, commercials all the time. Check your credit score, right? And some are not all made the same, right? Paid versus free versus where do I go direct? We can get into credit scores another time because it's a really important part of our life. Well, companies and governments are really no different. They're on a different scale, a different rating system, but they're going to have a credit rating. The higher their credit rating, the lower the risk of giving them money, of lending them money is. Well, that's also going to qualify them for a little bit of cheaper interest, right? I can't ask a company that's at the top end of the credit rating scale to pay me the same interest rate that a really risky company that's really irresponsible, or maybe they've been downgraded quite a bit and they're struggling, their profits are falling off, and so they have a lower credit rating. Well, that's going to carry a lot more risk. I, as the investor, need to get paid for more risk, right? So if I take more risk, hopefully, right, the goal is to make a little bit more, right? Safer is going to be a little bit lower revenue, lower interest. But we have to be really careful about who we're lending money to when we're going with bonds. Bonds are have been seen as the safety investment as it relates to stocks, right? So stocks is where we've gone for traditionally in investing for a lot of growth. Bonds is where investors have gone for a lot of protection from all that volatility of the market. Well, if I'm going into junk bonds, which is basically low credit bonds, those have a lot more default, which is bankruptcy, where they don't pay you back, than the top end. So I have to be really careful and smart about how I'm doing those. Now, I also need to look at what is the interest rate risk associated, right? So when the Fed sets interest rates, and we've seen over the last 10 years, those interest rates have come down drastically, right? When interest rates come down, that means that new bonds that are coming out have lower interest, relative to their risk than prior, right? So that affects the price that bonds trade at, but it also affects what I'm making over a long period of time. If I have a bond that is a 30-year bond, right, it's a long-term holding, and interest rates go way up, and mine is sitting here at a really low interest rate for the same amount of risk, mine's suddenly worth a little bit less, right? If I have a bond that is long-term and the interest rates have come down, well, I get a little bit better value on my bond if I were to sell it early, because new bonds with the same risk are coming out at a lower interest rate. I'm earning more. So they call that par value. They'll adjust so that they're basically the same. So at the most basic level, though, we have two forms of traditional investments, right? The start of the investing world. Stocks are ownership, bonds is debt or lending, right? So I've got a loan or I've got equity and ownership in a company. Then we start to, as an investor or as an advisor, we can then help clients or you as the investor can go build a portfolio out of these things. I want to balance out stocks in different types of classifications, bonds in different types of classifications that all have different goals, and how does that blend together into a proper portfolio for me for the long term. All right, guys, that's it for today. But before you go, make sure that you do me a favor and like and subscribe the video. It helps us with the YouTube algorithm, making sure that all the content comes up for you guys. And if you click the notification button, it'll make sure that it sends you that notification when we release new videos and updates. Do me a favor as well, make sure that you comment and question below. We want to make sure that this is relevant for you. We want to know what's confusing you, what's holding you back, what's something that's really exciting or new and interesting to learn about. We want to make sure that we're helpful here. I think an educated investor is a more successful investor over the long term. So all of those questions and comments from you guys will help us make sure that we're generating videos that hit home. Hope you have a wonderful day. Thanks for tuning in. We'll talk to you soon.